It does take us to our talk of the tape, all that lies ahead for your money this week. There's so much on our plates. For more, let's welcome in Liz Ann Sonders, Schwab Center for Financial Research Chief Investment Strategist. Welcome back.
Thanks, Scott. Nice to be here.
Are we just sort of in a holding pattern here before we get NVIDIA and then ultimately we hear from Chair Warsh at the end of the week?
Yeah, but I think it's also consistent with the kind of churn and rotation that the market's been in for quite some time. I think rotation in and of itself is the new momentum trade, and I think increasingly there's a lot of money sort of playing those rotations, whether it's the institutional side, the commodity trading advisors, systematic funds, the long-short hedge fund community, playing off each other's positions. You get these really swift moves that sometimes might appear to just be churn waiting for, to your point, NVIDIA earnings, the Jackson Hole speech. But I think it's just part and parcel of the mechanics of the market these days.
Do you think that this week is pivotal in how this market trades from here because of what lies ahead?
Depends on what NVIDIA says and depends on what Warsh says. You know, NVIDIA, for all the discussion about concentration within the market, there's actually become less concentration when you look at the influence of a cohort like the Magnificent Seven. But where you do still see significant concentration is at the earnings level. So if you look at 2026 year-over-year estimated earnings for the S&P 500, and you look at the top 10 stocks providing those earnings, NVIDIA is number one, and it's 18% of overall S&P expected earnings growth in 2026 relative to 2025. You add Micron, which is another 14%. That gets you to 32%. That's a third of expected earnings growth this year coming from two stocks. So we may have alleviated some of the concentration problem as it relates to the weights within the indexes, but it's still there from an earnings standpoint, which is why it's such a pivotal report tomorrow.
It doesn't usually, trade that well on the back of earnings, but some are suggesting that this report has more to do with everything else than it does NVIDIA itself. I mean, we know the report's going to be good. We know the commentary from Jensen Huang is likely to be good, but there are hundreds of stocks, quite literally, that could move based on what they do and what he says, because they're all so tied in the ecosystem. That in and of itself is why this report looms so large.
Right. And the ecosystem has gotten so much more diverse and broad, and it's why you're seeing plays down the cap spectrum into other sectors that, at least on the surface, might seem to only be peripheral beneficiaries. And I think that's been the name of the game in an environment where the monolithic decision of yes or no to the Mag 7 has given way to more connectivity between prices and fundamentals, and a broader swath of opportunities, not just in the AI and AI-related space, but obviously in the energy space as well. And I just think that there's a lot of money looking for different and shiny new objects than what was the case, say, last year.
Are you feeling pretty good, though, about where the market is? I mean, there's a lot going on. There's, the momentum factor hasn't traded all that well. Now we have this worry in the bond market, the intervention by Treasury. We still got to figure out what's happening with Iran, whether that situation is going to get worse before it tries to get better. So there's a lot here. The reason why I think the market's traded so well in the face of a lot of that is because the earnings story is so compelling that it just trumps everything else.
For now, the one note of caution regarding that is when you get earnings growth to such an elevated level, especially absent what can cause earnings to jump significantly. When you're coming out of a recession, you've got the base effects accruing to the benefit of the earnings growth rate. That's obviously not the case this time. The base effect in the case of last year was still strong earnings growth. The one thing to be mindful of is that better or worse can often matter more than good or bad. So at some point, we're going to price in the inflection point. There's going to be less of that extrapolation out into the future. And it's one of the reasons why periods where the S&P earnings growth has been more than 20% has not been disastrous for the equity market, but kind of low single digit, more middling kind of returns because of that function on the part of equities to price in that inflection point, to understand when things stop getting better and they start getting worse. We may not be imminently at that point, but I think that's another reason for some of the churn is it's increasingly on maybe more radar screens than it was a quarter or two ago.